Welcome to the supplemental video update. This is a video designed to go through charts outside of the SPX Investing Program that we use to get some insight and information. Some of these charts can be a little difficult to understand because they don't have a lot of explanation. So I go through these charts and try to explain them in the simplest way that I can while trying to also fit into something that is actionable and useful to us as investors. This is being prepared for February 21st through the 24th. The first area that we look at, I used to include in the weekly video update. It's called Current Market Valuation. It's a pretty useful site. They update their charts usually about once a week. The problem that I've run into is that they're supposed to update these charts on the weekend, and sometimes it's the middle part of the next week before they finally get around to updating them. Using them in a timely fashion is not really possible. I go and check the website numerous times, and when they do make an update, I'll use the charts, but if they don't make an update, then I won't include those in this video. The first area that we look at is overall, they're suggesting that the market is fairly valued right now. And here is a historical chart showing how we're above this dashed line. That's positive. We have not reached this yellow dashed line here, which is a standard deviation of 1. If we get above that, that means we have become overvalued. Now we break down the different components of this report. The first one is called the yield curve model. And this is very overvalued right now, or strongly overvalued, because we are inverted. This compares the 10-year yield with the 3-month yield, and the 3-month yield is higher than the 10-year yield right now, and that's why we're getting such a crazy reading right now, and that's suggesting that we might see a recession going into the future. Another thing we look at is the state coincidence index model. Are states overall rising in this value or declining in this value? Well, when they're declining in this value or decreasing their own state coincidence index, the more that are decreasing, the more likelihood that we will run into a recession. And it says here, as of December 21st, there are 22 states with a decreasing SCI, which we assess as a market rating of overvalued. Over on the left side, they say on average, if more than 25 states are in decline, the U.S. overall is entering a recession. So we're just under that. We're at 22, where we need 25 to generally be considered in a recession. Another area is the Buffett indicator model. This compares the value of stocks with GDP, and we're getting a little bit above this yellow dashed line. That's 1 standard deviation, and now we're considered to be overvalued. The PE model also suggests that we're overvalued. We're above this yellow dashed line, and we're slightly above the +1 standard deviation. The interest rate model is fairly valued. We're above the black dashed line, but we have not reached up to the +1 standard deviation dashed line. Margin debt, which hasn't been updated in a while, this is as of the end of January, shows that we're fairly valued. We did cross down below this green line and we were undervalued. Well, as the market started going up in the early part of 2023, we're seeing more folks using margin to buy stocks. The S&P mean reversion model, the black dashed line, is just a historic trend line of what is the price of the S&P 500 on an average basis. When we get too far away from that, we're becoming overvalued, and right now we're just above this dashed yellow line. Looking at sentiment, we're getting over into the extreme positive area with some of our charts. Some of these are a bit outdated. We saw some weakness in this past week, so some of those sentiment indicators have probably dropped a little bit since this time. Here we have another sentiment gauge suggesting that we're positive and not in the frenzy category as they define it. Here is the latest reading from the American Association of Individual Investors. We really only pay attention to this when we're at -30 or below. We're above 0 because the market's been positive. That means individual investors are positive because they follow the market. They don't necessarily proact to what's going to happen. They react to what has already happened. And since the market was going up when this survey was taken, we see a more positive reading. We really only pay attention to this now when it goes back up above 30. That will be extreme positive if we even reach that level. Another sentiment indicator is just suggesting that there's light positioning right now in the stock market, and that kind of goes hand in hand with some of our other indicators. People are scared. They really got spooked and burned in 2022. They don't want to jump in as heavily in 2023, fearing that the same thing might happen. Another sentiment indicator, we're up near the top of this particular indicator, and it is positive, but we're starting to get extreme with the sentiment. Another way that people are feeling is the rally since the late September and mid-October levels, generally viewed as a bear market rally. Most people just think that. And it doesn't matter what people think, but people like to take a position and then stand on that. Only time will tell whether this was just a bounce in the midst of a bear market, or are we starting some kind of a new bull market phase. What are the most crowded trades right now? Right now you have folks really into being long in Chinese stocks, and then investment grade bonds, followed by the US dollar, where it had been a lot more crowded in January. A lot of people got out of the dollar, and now they're putting that money to work. Long treasury bonds and ESG assets, which again is kind of controversial, and we'll have to see how all of that works out into the future. Are they long oil, and are they long emerging market bonds? We're seeing a little bit of favorability going into emerging market stocks as well as bonds. Another way to measure what's happening in the market is looking at discretionary, meaning that you can choose what investments you want, you can choose when you get in or when you get out, versus a systematic approach, which is where you have a set of rules, your entry and exit points are well defined way beforehand, and you don't change things along the way. Well, the discretionary investors, they're seeing the market going up, so they're starting to get back into stocks. And the systematic approach is also seeing an increase in stock buying. It's lagging behind the systematic approach because you don't use as much emotions with the systematic approach as you do with discretionary. And people see stocks going up and they want to jump in. Looking at the bullish sentiment, both on the retail and institutional side against the S&P 500, this is really just a historical chart. I'm not going to go through every point in this. You can just pause this and see what sentiment was like and then what the market did after that. The active managers, they've increased their exposure quite a bit. In fact, we have a more recent reading in the weekly video, and we're well above 80 right now, so we're starting to get extreme positive. This chart is also showing that we're underweighted in bonds and starting to turn back up, and that could suggest good things going forward for bonds. If bonds go up, that means interest rates come down, and that can also give some support to stocks. This is another way that people are feeling their risk appetite looking out over the next 30 days. They're not all that happy about things. They're still looking at things in a negative way, so they're not taking a lot of risk right now, and the projected outlook is that we will be down within the next 30 days. This chart asks, what level of risk do you think you're currently taking in your investment? After it really was coming down in 2022, we're starting to go back up, so people are willing to take a little bit more risk when they see the market going up. Looking at the economy, this is the daily shot chart showing the economic surprise index. When an economic report comes out, if it's greater than expected, that's a surprise to the upside. If it's weaker than expected, that's a surprise to the downside. As economists are projecting a real slowdown in the economy, they're lowering their expectations for the economic reports that are coming out. So when we get stronger than expected ones, it really makes this chart jump up. And that really caused some problems over the last week. We had CPI, PPI, retail sales. All of those were much greater than expected, and that caught the market by surprise. Here's the real S&P 500 index. Real means they take into account inflation, and this just shows historically how long these different market moves have lasted. You can just pause the video to look at this chart if you desire. Then we also had the leading economic index come out, and it continues to signal a recession over the next 12 months. Looking over here on the right-hand side, when it's below this dashed line, that's a warning signal and also a recession signal. Looking at the GDP Now forecasting, where the folks that forecast what the GDP is going to be, it's anywhere from just under 1% down to about minus 1.5%. And everywhere in between. The Atlanta Fed GDP Now estimates it at just under 1%. Not negative, but nothing really strong. This chart is from the Fed, and it measures newly private-owned housing units that are authorized in permit-issuing places. Really, we watch this when it starts to go up and then turn back down. A lot of times what will happen as it's going back down is we will run into a recession. Well, we've been going up and turning back down now. Is that going to lead to a recession at some point in the future? This is the M2 money supply. This is the largest measure that we still use to measure how much money's out there. It really went up during the whole COVID plunge as they were adding all this liquidity to the market. Well, now it's really been coming down. And the blue area is just CPI, the inflation, when it topped out in June of 2022, and now it's been coming back down. So to see the M2 money supply and inflation go hand in hand is not necessarily surprising. This chart suggests that the recession fears have peaked. They peaked back in November and have been coming down since. This chart says that a recession has never occurred with negative real interest rates. That, again, real means that it's taking into account inflation. When you look at the 3-month bill minus the 12-month CPI, that gives you a negative rate. And they say that we've never had a recession when this has happened. Here's a look at real retail and food services sales. They continue to be quite strong overall, which is not necessarily suggesting that we're heading into a recession. The lending standards are too tight. I actually showed this same version of this chart in the weekly video. It just shows that banks are starting to tighten their standards for those that borrow money, and that really may prevent us from having a soft landing. The demand for loans has really been decreasing. It was a lot weaker in January, and we see it really coming down here. And some of this may have to do with the tightening standards that banks are going through, since it's harder to get a loan. Looking at inflation, these are the expectations of inflation. A lot of people have really brought down their inflation expectations. This chart just says the U.S. trimmed and median CPI proving sticky for now. Sticky are those prices that don't change all that much. When those start to go up, they tend to hang around, where other prices just ebb and flow with what the economy's doing. Some of these are going up and some of these are going down, but overall they've really been rising over the past year. Looking at employment, you have the ISM manufacturing PMI against the U.S. non-farm payrolls. These are manufacturing jobs. The dark blue line is ISM manufacturing, where it's really been decreasing, but the non-farm payrolls has really been increasing. And so there's something out of balance here. Is the ISM going to turn and go back up, or are non-farm payrolls going to start coming down? This chart suggests that it won't take much unemployment for hard landing fears. Employment has really been climbing up, and retail sales have also been rising. If we start to see some employment problems, people can't go out and buy things, so that could really lower the retail sales. Looking at earnings and valuation, this is a little bit old now, but this is where's the S&P. When you look at its forward PE multiple, it's right at about 18 times earnings. When we're at 15, that's considered fair value. When we're at 20, that's considered expensive. Now, if you look backwards, we're still historically expensive. We're well over 20. This chart says historically the Fed is cutting rates in an earnings recession, not hiking them, and we're in a rising interest rate environment right now. This is the 2023 consensus that the earnings per share is falling off a cliff. All of these lines just show how we've been coming down. The dark blue line is where we're at right now, and that's ultimately what drives stock prices. And so the fact that these EPS revisions are coming in and going down, that could really put some problems into the stock market. This looks at the 10-year Treasury adjusted for inflation bonds, how they've actually been going down, and the forward PE ratio of the S&P 500 has been going up. Here we have the S&P 500, the next 12 months EPS yield gap against the 6-month T-bill yields. Just shows that there's a real wide gap between them currently. This is the sector valuation dashboard. I won't go through all of these. The blue area is just what the current PE ratio is. The blue triangle is the 10-year average. The yellow triangle is the 10-year peak, and the red triangle is the 10-year trough, or the low. So the yellow would be the high, the red would be the low. This chart suggests that private clients are allocating to bonds, not stocks. We're seeing a lot of inflow going back into bonds. Looking at the cumulative fund flows across assets, we still have a lot of folks that are in money market funds. That's way in the lead, followed by stocks, and then government bonds, and then at the bottom are the corporate bonds. This chart shows that we're seeing the largest tech outflow since last fall. This chart is suggesting the weekly equity fund flows are decreasing. There's less money going into the market to buy stocks. This chart also says that this is the largest outflow of high yield bonds in 8 weeks. Here are the corporate buybacks. They're still pretty elevated. You have a lot of corporations that are buying back their own stock, which can give some support to the market. Insiders, after being really extreme, which is bearish, it's really been coming down now and we're getting back more to a bullish stance. This is a historical chart showing the Fed tightening cycles, and they always tend to break something along the way. We're still waiting to see if that's going to happen in this particular cycle. This is the market pricing for the Fed funds rate change after the March 2023 meeting that is still yet to come along here, and they're still suggesting that it's going to go higher. The general feeling right now is that it's going to be 25 basis points. Well, when we have these stronger economic reports that are coming out, now people are talking that there's a possibility of 50 basis points. If we still see more strong economic reports, this will continue to go up. Here's our overbought, oversold composite. We're not really hitting an overbought reading right now. We have a reading at 72.73. If we go up into the 80 range, that's when we are considered overbought. Here's another historical chart. I won't go through this. You might just want to pause this and look at it. It's when different things have happened, and then interpretations as to why it ended up happening. These are folks that are saying, yeah, it's only February, but if you annualize how the market did during the first part of 2023, my goodness, we're up 48% on an annual basis. That would be a good, solid return. This chart suggests that stock returns have become more micro-driven in recent months, meaning looking within the company for earnings rather than in the economy as a whole. So we're seeing a real improvement with this chart. This chart is just saying this is the best start to the year for a 60% stocks, 40% bond portfolio going all the way back to 1991. What are the tail risks, or what I call headwinds, that could get in the way of the market continuing to go higher? Well, that inflation stays high, geopolitical events that happen, a global recession, the central banks are really hawkish, meaning they're raising interest rates, systemic credit event that starts maybe in one area or in one country and then bleeds out across the globe. This chart is suggesting that the US dollar is oversold and it's due for a bounce, and so far we've been seeing a little bit of follow through with the dollar going back up. This is looking at European stocks. It says the equity risk premium is now below its 10-day average. Stocks are not cheap. So thank you very much. I hope you found this helpful. It's a little challenging sometimes to look at these charts and try to figure out what they're trying to get at when there's really not an explanation. But I hope that this, combined with the other videos that I post online, will be helpful to you to make decisions. So I will talk to you in the next video.